Hello, everybody. Welcome to today's show. I found out that Mike is off skiing, so I figured I'd do the show on my own. We will run through the normal slide deck today, and this will be more of a condensed version. And I guess this is more of a presentation than a conversation without Mike here. But if you do have any questions or commentary, then please feel free to chime in. I will share my screen and we'll get off and running here. Let's see here. And away we go. Hopefully everybody can see that. I just a shameless plug here. I wanted to point out and make sure everybody was aware. Alex Mead from StoneX and I are officially going to host Risk Management Academy in Nashville later this April. The dates are definitive now. It's April 27th through the 28th. This is going to be more of an intermediate to advanced type seminar versus a Futures 101. This is kind of, I guess you could think of it as more of a Futures 300 type class. So if you have any interest or questions, you can Google this through StoneX or just reach out to myself and we can pass along the information. I appreciate the vote of confidence there, Alan. So we'll start big and then consolidate down into lumber. I mean, I think the big thing that stands out to me as we start this week and ended last week is Treasury. 10-year notes are up to 3.91%. So we're trending in the wrong direction from a housing standpoint. Interest rates are back at November levels now, and it's definitely you look at equities this morning, the Dow's down about 550 points, NASDAQ's down about 220, S&P's down about 65. So the market is having to contend with the idea that rates are probably going to stay higher for longer and the Fed's not done. And again, with rates trending back again at the low water mark about three and a half weeks ago, this 10-year note was 3.41%. Now you're back up at 3.91%. It's putting pressure on equities. It's really putting pressure on just about everything out there. And here's the S&P. I follow a bunch of Elliott Wave guys, and everybody's been talking about S&P in the 40-50 area. You're starting to break down now underneath this level, so it just opens up the potential for more of a sell-off in equities, where you could see the S&P trade down into this 4,000 to 3950 area as the next downside target. And when you look at kind of what the Fed is saying versus what the market's trying to interpret here, the market's kind of on the wrong side of this right now. The Fed has said all along we're going to float up to a Fed funds terminal rate of about 5.25, somewhere in this 5.12 area, 5.25 area. The market's expectations it was down here, and then you could see the potential for a rate. Amazingly, the potential that the Fed is actually going to cut rates into the end of the year, and you can see how this has shifted now as you've progressed week after week after week, where the market's coming to terms with the idea that rates, you're not going to get a rate. Again, this is based upon the Fed's verbiage. You're not going to get a rate decrease going into the end of the year, and the market's having a very difficult time reconciling this from an equity standpoint. And you even had Jeremy Siegel, who's an uber bull, come out this morning and say he can't rule out a 0.5 basis point increase with the next FOMC meeting. So it's definitely something to watch, and it's definitely putting pressure on markets. And for what we want to see from a housing standpoint, rates are trending in the wrong direction, pure and simple. The other big news that was out this morning, Home Depot and Walmart both had their Q4 earnings. Both referenced the idea of a consumer slowdown, so they're starting to see it firsthand in their outlook. And Home Depot, the number that jumped out, the headline number was Home Depot misses revenue expectations for the first time since 2019. So obviously earnings were fueled by the pandemic. everybody shifting to home from work, and you've come full circle now where you're back to revenue type guidance pre-pandemic. And they did, interestingly enough, reference lumber and being unpredictable and difficult to gauge what the future looks like there. We all know that. And so when we go back, the other big, we talked about interest rates. The other big thing influencing markets is the US dollar. And we're starting to see some more appreciation in the US dollar. And typically outside of copper here, that puts pressure on other physical commodities. And when you look at kind of year-to-date returns, winners and losers, interestingly enough, I guess the flight to quality has been in Bitcoin. More power to those that saw that coming. You still see NASDAQ, Russell, the S&P up here. You're just giving back some of these yearly gains so far. And then the other big one here, copper. So some of the other physical commodities are up here. And then when you look at losers, and lumber's basically in the middle of this pack here. Lumber is basically unchanged, or I think down maybe 0.5% for the year. So whatever big gains we had to the upside, we've basically given them all back in lumber, and we're pretty much unchanged or within 1% in either direction. But you could see some of the big losers here, obviously natural gas. And this natural gas down here, I think, is being more influenced by a much milder than expected winter in the Midwest and the Northeast. I know Cleveland, where I'm from, if we don't have any more snow for the month of February, we will have the least snowiest February on record. And those records go back to the late 1880s, 1890s. So it's been a pretty mild winter. Crude oil's on this list. And so the reason I'm going to reference crude, I'll come back to this slide here, but when I look at crude, I saw this on, I think this was yesterday or Sunday. I'm not sure what the mindset here, but our strategic petroleum reserves, the SPR, were at the lowest level since August of 1983. So I'm not sure what the government's mindset is, but from where we were basically in 2021, start of even 2022 to where we're at today, it seems like a game of chicken with an industry that's not building out capacity, that's not building out production. So at some point, this is something to watch. Does the government, who wins here? Because this seems like a pretty big game of chicken. And I'm going to go back to this. And this is from Goldman Sachs. And this just shows, when you're in certain phases of economic growth, from contraction, recovery, expansion, slowdown, those are your 4 phases of economic growth. It gives a good kind of synopsis of how the different major asset classes perform. And you can see, the expansion recovery phase, equities. So when you bottom, equities lead the charge to the upside. As you're expanding, commodities come into play. And as you slow down, commodities, bonds outperform equities. And, what part of are we, I think it's pretty safe to assume we're in this slowdown phase. We're probably somewhere in this range. So it's going to be interesting to watch where, again, the reason I bring up crude oil and commodities as a whole, I'm not going to get overly bearish on commodities. Even if we're going to go into a shallow recession, I think that commodities are still likely to outperform a lot of asset classes, especially as China comes back online. So I'm not going to get overly bullish on commodities here. Something to definitely watch. Again, we talked about treasuries, 10-year notes back above 3.91%. Again, you're back to November type price levels now. And you're seeing this with 30-year mortgage rates where your 30-year is trending back up and it's above 6.5% now. You're trending back up into that 6.75. Can you go back and retest? Here's your December, November highs. At one point we were above 7%. So we're definitely trending back in that direction, which is unfortunately a headwind for housing as far as triggering new demand. Something to watch later this Friday, PCI, or I'm sorry, PCE, which is basically consumer inflation. This is the Fed's favorite metric for watching inflation. And when you look at PCE, you seem to still be trending in the wrong direction. So this is, I think, has a lot more influence on Fed policy from an inflationary standpoint versus CPI and PPI. So again, this is out along, I think, with consumer spending on Friday. So something to watch later this week. Um, Positive for housing is that builders' confidence, builder sentiment seems to have bottomed. This was out last week, and it looks like we're trying to put in a nice double bottom here. So that's something encouraging to watch. Obviously, we had housing starts last Thursday. Both permits, I was disappointed in the actual permit numbers. You did see a tick up in single family. However, that single family was more than offset by a decrease in the multifamily component. The other thing that you're starting to see is that big backlog of housing we were trying to catch up on last year, housing completions. That's starting to trend back down. So again, if I want to just look at averages here, permit starts and housing completions, you're going to settle out somewhere in this 1.3 to 1.3 million area. Now, those historically aren't bad numbers. It's just not the growth potential that we've had the last 2 years. So the reality is you're still going to have, starts aren't going to zero, but at the same time, it's going to be difficult unless you can get interest rates to play along here to really kind of forecast something back above the 1.4 or even the 1.35 something. You need some outside influence like interest rates cooperating from a starts standpoint. The other thing I'll reference with starts, and I'm not sure how to react to this, builders out there, I'd love to get your take, but for the first time in history, built for rent units are outpacing built for sale. So the single family component, which is the red line, is being outpaced by the built for rent. So again, if people can't afford homes, we all know they have to live somewhere, which is ultimately bullish from a housing standpoint. But the problem is we're seeing more interest to build to rent than build to own. And I'm not sure how this is sustainable. If we're going to really grow housing, you really need to see the single family component. This is how you organically are going to grow housing and get back to some loftier levels. The multifamily, the built for rent component, that's encouraging in that you got to build something, but this is the one you want to see kind of show signs of a bottoming and coming back to life. I thought this was really neat, Texadus. This was put out by Keith Hughes, who puts out some really good stuff on LinkedIn. Um, so when you look at kind of, we talked about migratory patterns with the pandemic. California and New York lost about 500,000 people. Texas total population grew nearly 900,000. Florida's population came in second, growing 706,000. So you still have this exodus out of high cost states. And again, and it get overly political, but when you're going to look for growth, signs of growth and housing, organic growth, you got to still watch Florida, the Carolinas, and Texas, and you want to see signs of a bottoming, signs that these markets are coming back on, because this is where the population is shifting to. Getting into lumber now. Kind of whatever goodwill was out there the last couple of weeks. Here's a monthly, here's a weekly. We're giving it all back, and we still have that January continuation gap at 344. When you look at a March daily, from when we bottomed here, right before January expiration, you basically had 14. So from a pattern standpoint, you had 14 days to the upside. Today would be 13 out of 14 down days. So from a pattern standpoint, once you get into this 14 to 21 day period, That's kind of your count to the upside, downside. So, is this good enough? Do you have to come back and fill this gap at 344? The low in March, and this is a March continuation chart, so it doesn't show that low in March, but the low in March was a 360. So March today has gotten down to 76.30, 376.30. That's basically the low from Friday. The May low so far is in this 400 area. The recent low in May is in that 380 area. So the one thing that jumps out with 13 out of 14 down days, we're probably getting, and here's the May mini chart. You can kind of see the same thing. This is more of an aberration here with somebody trying to paint a picture on the close. Basically has the same down number of down days with May, both the May Legacy and the May Mini. But when I go to, I'll come back to these charts. When I go to open interest, yeah, we continue to shed open interest. But 13 out of 14 down days, we've had some up days there. And so that makes me think anyway that this isn't all liquidation. These aren't all long getting punched in the face out of this market here. I do think that you've seen fund selling. So whatever fund shorts got stopped out of the market on that run to the upside, I think you've had new fund selling come in where the funds are selling March. And probably selling some May, but also selling March. So that sets up and again, we won't know this, unfortunately, because with the CFTC numbers, last CFTC report is still the 24th of January. CFTC did put out an update on the 16th that they're hoping, where is it at here? They're hoping that they can publish something on Friday, the 24th. Here it is right here. And the problem with this is they have to go back to the beginning. So the last report is the 24th. So what they'll do is release the next report, which would be January 3rd or January 4th, January 3rd. And then they have to go back and hopefully give 2 weekly releases. I'm not sure how they're going to do it. They haven't stated that, but to get back to real-time data, you're probably talking at least a good 2 to 3 weeks to have any consensus of where real-time CFTC numbers are. So going back to this open interest structure, I think that the funds have been selling this, but I'm not going to be able to know that with any degree of certainty until the CFTC can catch up on their reports. And that's still a ways off, unfortunately. So going back to, here's the May chart where we left off. Here's the spread. Spread has gone from basically, this was the point where the fund, this is basically your highs when we had gotten up to that 530 area in March. Okay, the funds got stopped out, so it's been this descending price pattern where we got as low as the negative 29.90 area late last week. On Friday, you did have a nice reversal where somebody was rolling in the other direction. So that spread went from negative 29 back into negative 21. So far today, you're back into the negative 20 area. If there are fund shorts in this market in March that have to roll into May, then my expectation would be into next week, the beginning of the following week into month end, this spread could potentially get pushed back in. And then at that point, all bets are off. I've got people that think the spread could go dramatically wider, that it could narrow dramatically in. I think it's difficult to gauge what this spread will actually do until you get a real updated version of the CFTC numbers. So I think the mindset here is going to be lighten the load as you get closer into the end of the month and into the spot month, March 1st. From a historical perspective, so again, this includes 2021, 2022. These are your seasonal price averages. So you can see if you're a believer in the last couple of years, the market has an uptrend here into the middle of March, basically into March expiration, and the real highs aren't put in until May. Uh, um, and you can kind of see the green line is this year. If you're a believer that the last 2 years were aberrations and you take out 2021 and 2022, then the market's topped. I mean, the old adage of don't fall in love with your longs going into Valentine's Day should play out. We typically seasonally, historically, when you look at averages beyond the last 5 years, the market tells us that we top out into the third week of February. And then you have this downtrend really all the way into June, almost going into the 4th of July. So, historically speaking, when we take out the previous 2 years, you're kind of right in the middle of seasonally, historically, where we belong. You know, you've had complete reversion to the mean where, you know, this $400, $380 area. Well, again, if you throw out the last 2 years, this is where we belong. So, you know, what side of the fence do you lie on? And this kind of goes back to why did we rally? You know, the last couple, 2.5, 3 weeks ago, why did the market rally? The market rallied off the idea that there were curtailments out there, and what was proven was that the demand wasn't there to support those higher numbers. So if you want higher numbers, hint, hint, sawmills, keep the curtailments coming. I know Conifex announced something on Friday. They're going to take 7 million board feet off over the next 2 weeks. There's rumblings with an eastern sawmill that they have curtailments coming, although nothing will officially be publicly announced. They're just reporting it to their customers, so I'm not going to say what sawmill it is. But the reality is we probably still need to take 1 billion to 1 billion in board feet off this market, out of this market, to get closer to equilibrium. So you either have to see an uptick in demand, which is going to be more difficult given the wrong direction interest rates are trending. So the reality is you need more curtailments to kind of stabilize this market and push prices higher. And then when you look at, again, throw out the last 2 years, here's average March pricing dating back to 2000, $381. Yeah, you're probably still toward the higher end of March expiration levels. Same thing in May, $401. You're still toward probably the upper end of where March historically belongs. And if you're a believer, throw out the last 3 to 5 years. May is not a winning contract. May is a losing contract historically. So the idea that we could have seen the highs for the year, I'm not willing to say that. But historically speaking, if we have this reversion back to historical mean type pricing from a pattern standpoint, then highs are typically seen in Q1. I don't know if I necessarily believe that, but where is this market? Do the last 2 years mean anything? And this is the difficulty. And you know, Home Depot is absolutely correct in that this is a very difficult market to forecast and project. In that, you know, there's a lot of different things pulling from all directions on lumber right now. But again, what could impact this market the most? It's supply, it's additional curtailments, permanent curtailments, temporary curtailments. Take more supply off of this market if you want a higher price band, because I don't think demand is there. I think from a demand standpoint, Q1 is in the books. Q2 is going to be a slog. If you want greater organic demand in Q3 and beyond, then you can't control interest rates, but you can control production. So we need more curtailments to kind of generate a higher price band in all species, not just Western SPF 2x4s and futures. Here's our curve. Again, your cost to carry. This tells you that cash and March are the cheapest wood out there in both the mini and the legacy contract. When we look at the basis, same kind of thing in that this is cash minus futures. So futures theoretically is trading at a bigger discount to cash, although I'm not sure it's $40 because the mills are in that 324. I'm sorry, call it a 424 this morning. So futures represents a pretty good buy opportunity. relative to cash being your best sell. Here's the May contract, seasonal basis. This is a weekly seasonal. So again, throw out, here's 20 through 22, and you want to just go back into what we were prior to the pandemic, you're kind of right back into that channel, historical long-term channel of where basis opportunities. And you know, I'm all ears there. Anyone else hear anything about floor prices forthcoming? You know, the difficult with floor prices and sawmills is that when mills say, you know, this is our floor price, floors become ceilings unless you do something about it. So saying we're not going to go below a certain price only has meaning if you're willing to do the dirty work and take curtailments. We talked about open interest CFTC numbers. The other thing that somebody had asked about last week, and we hadn't shown these charts in a while, railcar stats. You can see that we're substantially better, and this is probably a good indication of much seasonably better winter weather than we've experienced the last 2 years. So we're nowhere near where we were the previous 2 years. And when you look at Canadian rail shipments, you're right in this, you know, kind of the worst, kind of what transpired. You're there the last 2 years, and then you start to improve. And I would think that this is likely to see, you know, again, it's not nearly as bad as it was the last 2 years. And history shows that now, as you get to the back half of February into the beginning of March, you start to improve anyway. And then the same thing from a US standpoint, you're nowhere as bad as you were in 21. So rail situation, love to hear people's take on that. Doesn't seem to be nearly as bad as it's been the last 2 years. And that's pretty much everything I had. I tried to condense this down a little bit. We're doing okay on time here. And again, anybody interested in coming to Nashville to see Alex and I kind of go over some of more intermediate to advanced, you know, I think we're going to cover technical analysis, seasonal, bear market, bull market structures, really kind of try to get very deeper into the weeds as far as kind of very specific basic examples, basis examples, option strategies, spread strategies, a little bit more in-depth analysis of how futures can be utilized from a risk management standpoint with cash. I appreciate everybody's time. Nick, thank you so much for setting this up. Mike, I hope you're having a fun time skiing. I appreciate it, everybody. That's all I had for today. Thank you guys so much, and we'll see everybody next week. Take care.